Good morning, students. Very good morning to you. And today we are here to revise the second chapter of CA Foundation Business Economics. A brief introduction about how the second chapter is structured as far as your examination is concerned. Let me tell you that second chapter has very big weightage on your examinations because the chapter is divided into three different sections. Although the chapter name says theory of demand and supply, it is not limited to only demand and supply. There are three different units among them. There is demand, which we have to go through in a very detailed manner. Secondly, there is theory of consumer behavior, and thirdly there is supply. So there are three different units which we have to cover today. So any topic which we deem to be easy, we will be going just over it. We won't be going any in depth, and there are some topics which are very important which we'll be going through fully. Now, without further ado, let us start with demand. Demand is unit 1 of chapter 2. The name of unit 1 is law of demand and elasticity of demand. Law of demand and elasticity of demand. Now, what are we going to learn in this? Correct? Let us just have an overlook of what we are going to learn in it. We are going to learn about the law of demand. We are going to learn about the determinants of demand. We are going to learn about the demand schedule, demand curve, expansion, contraction, increase, decrease in demand. Then we are going to learn about elasticity, four different types of elasticity: price elasticity, income elasticity, cross elasticity, and advertisement elasticity. Then we are going to learn about a small concept called as demand forecasting. Now, let us start with the meaning of the word demand. Everybody has definitely known what the meaning of the word demand is, what constitutes demand. I had told several times that there are three metrics on which demand will be decided. If I look at a really good car and if I think that I want that car, that doesn't make it a demand. In order to constitute a demand, there are three different things. What are those? First, there should be a desire. Second, there should be resource or means of purchase, we say, or means of purchase. Thirdly, we need willingness to use that resource, towards your desire. Now, only when all these three things are satisfied, it constitutes what? Demand. Now, going forward, what determines the demand? What are those determining factors which decide about the demand? Let us learn about that. First, the demand is mainly dependent upon the price of the product. We know that if the price of the product increases, we say ceteris paribus, which means other factors remaining the same or remaining constant. If the price of the commodity increases, the demand for that commodity decreases, correct? And vice versa. Secondly, there is price of related products. What do you mean by related products? Related commodities. There are two types of related commodities. You have to remember this. What are the two types? There is complementary goods and there is competing goods or substitutes. Complementary goods are those goods which are consumed together or consumed simultaneously. For example, tea and sugar, correct? And automobile and petrol, correct? These are one more example, the ink and the pen, correct? Now these are what? Complementary, correct? On the other hand, what do you mean by competitive? What happens when see, two commodities are called competing goods or substitutes when they satisfy the same want and can be used with ease in place of one another. For example, ink pen and ball pen. See, if your motive is just to write, okay, ink pen or ball pen doesn't really matter. If there is no ink pen, you will buy what? Ball pen. Just like that. These are what? Competing goods or substitutes. Now, let us go back and discuss about complementary goods first. Correct? What happens if the price of the complementary good reduces? There are two types of related goods. What are those? Complementary and competitive. Correct? Now complementary, what happens? For example, there is a pen which is sold at 10 rupees and there is ink which is sold at 5 rupees. Now what happens if the ink price reduces to 3 rupees? What happens? When the ink price reduces to 3 rupees, the demand for the pen will increase. If the petrol price reduces by 5 rupees, the demand for cars and bikes will increase. Correct? That is what happens. So the fall in the price of a complementary product will lift the quantity demanded of our product. Okay. Now let us discuss about the competitive goods. Competitive goods. Now, what example we are taking? Ink pen and ball pen, or sometimes we do take the example of coffee and tea. If there is no coffee, you will drink tea, correct? That is the assumption that we take. Let us take that only, coffee and tea. Now imagine coffee is being sold at 200 per kg, coffee powder, and tea powder is being sold at 150 rupees per kg. Now imagine that the tea price falls to rupees 125. Now when the tea price falls to 125, what happens? What happens? The people who are consuming coffee will now consume tea. Okay, this is the same if the price increases. If the price increases, what happens? People will leave and people will go to the other substitute. Okay, when a good or two goods are satisfying the same want, people will compare it on the basis of prices and they will do their choices accordingly. Next, there is income of the consumer. There is something called as income of the consumer. See, other things being equal, the demand for a commodity depends upon the money income of the consumer. The purchasing power of the consumer is determined by the level of his income. Do you agree with me? Correct? In most of the cases, larger the average money income of the consumer, the larger the quantity demanded for a particular good. If your income is more, you will definitely demand more. The nature of the relationship between income and quantity demanded depends upon the nature of the goods also. Correct? For example, see, most of the consumption goods fall under the category of normal goods. These are demanded in increasing quantities as the consumer income increases. For example, I can take clothing. See, if at all you're earning, let us say 25,000 rupees per month, and you are buying every month, you are buying, let us say, 3 pairs of clothes. Correct? When your income increases to, let us say, 40,000 rupees per month, you will definitely buy more clothes or you will buy much more costlier clothes. So as and when your income increases, correct, your buying pattern of normal goods increases. Normal goods means what? When income increases, their consumption also will increase. There are different examples. There is household furniture, automobiles, consumer durables, etc., etc. Now see, for example, there is another type, that is essential consumer goods such as food grains, fuel, cooking oil, necessary clothing, etc., which satisfy the basic necessities of life, are consumed by all individuals in a society, a change in the consumer income, although will cause an increase in the demand for these necessities, but this increase will be less than proportionate to the increase in income. That is, see, I will give a very funny example which I always give. Okay, with when it comes to essential goods, let us take let us talk about your breakfast. You might have today is Sunday, you might have just woken up, okay, and you might have had breakfast, correct? No, so on Sunday people usually get up late, so imagine that you had idlis, correct? Now how many idlis you can eat? Probably 5 idlis if you're very hungry, correct? Now imagine that you are eating 5 idlis when your income is 10,000 rupees, and when your income, let us say, goes to 50,000 rupees. Now will you multiply this with 5 and eat 25 idlis? Does your consumption of a essential good proportionately increase with the your income? Answer is definitely. You might eat something else, or you might eat something a little more, but definitely not in proportion with the income. So normal goods will change almost in proportion to income, but essential goods does not. Okay, I hope that this these things are clear, and I want to make sure that you know something about inferior goods as well. Inferior goods, everybody knows what's an inferior good. What is inferior good? Inferior good is that good, okay, when which are demanded only up to a certain level of income. Okay, only up to a certain level of income. The best example that I always provide in the class, you should remember what is that example. I'm talking about Maruti Alto. Maruti Alto, everybody knows, correct? Now I know that Maruti Alto is a car, and if your income, annual income is, let us say, 3 lakh to 5 lakh or something like that, you might demand Maruti Alto. But imagine, would you buy that car when your income is, let us say, 25 lakh per annum? Would you demand that particular car? Answer is no. Why? Because you were demanding for that car only when your income was at a certain limit, and after that you will not. Correct? Now this is inferior goods. Okay. Next, there is tastes and preferences of consumers. Another determinant. What is that? Tastes and preferences of consumers. Now see, every consumer, correct, and his taste and preferences change, correct? Now they always change over time. They never remain what? Constant. Goods which are modern and more in fashion command higher demand than the goods which are old, correct? Now the fashion keeps on changing. Clothing industry, we already know what happens there. The fashion keeps changing and the demand for new products will always increase, correct? In that there are certain effects that we have to learn. You have to remember this because a lot of multiple choice questions have been asked in the past and will be asked in the future, correct? There is something called as demonstration effect. Demonstration effect. There is something called as bandwagon effect. Demonstration or bandwagon effect. What do you mean by demonstration or bandwagon effect? You should remember this. You go to your neighbor's house and you see that there is a big Sony LED TV, and you come back home and even you want it, correct? That is the best example for demonstration or bandwagon effect, correct? By seeing it in somebody else, okay, you want that product too. Now that is called as a demonstration effect. Secondly, when a product becomes common among all, some people decrease or altogether stop its consumption. That is called as a snob effect. There is one more effect called as what? Snob effect. What is snob effect? For example, earlier, correct, having let us say a Royal Enfield bike. Okay, everybody knows Royal Enfield bike, correct? Now, earlier was a thing of a prestige, but today everybody has Royal Enfield. Understanding or no? So some people don't want that kind of a bike at all. They are going for a higher end bike such as Harley Davidson, etc., etc. Why? Because things have become common. See, whenever you have a greater money income, you don't want common things, you want something special, something extra, correct? That's what happens here. Okay, and that is called as what? Snob effect. Then we have to discuss something called as Veblen effect, correct? What is Veblen effect? Do you remember? Correct. See, what is highly priced goods are consumed by status seeking rich people to satisfy their needs for conspicuous consumption. Now please understand, you might have seen that certain paintings, okay, sold for millions, 2 millions, 3 million US dollars, correct? Now there will be auction. Okay, like, normal person like you and me, if I look at that painting, it's like, kya khas hai? Like, nothing. I can't really, like, see what is that value. But there are some status seeking rich people. Okay, for example, they want the sword used in some war which happened, like, hundreds or thousands of years ago, correct? Or they want a coin which was used in the olden days, correct? Now they buy that particular products because that gives them some kind of a status. Now that is called as Veblen effect. And the consumption, what it satisfies is conspicuous needs. Okay, we call them conspicuous needs. Okay, now we should remember this Veblen effect is given by American economist called as Thorstein Veblen. Okay, that question also might come in the examination. Going forward, consumers' expectations. Consumers' expectations. See, consumers' expectations are the biggest, correct? No, it is one of the biggest driver of demand. Okay, please understand this happens all the time in the stock market. How does the stock market move up or down? Mostly it is because of consumer expectations that the company may earn a lot of income in the coming years, which means I will start accumulating their shares today. I will raise the demand today. Yes or no? Correct. So, consumers' expectation with regard to price, with regard to income, with regard to supply, etc., etc. If you know that after 2 years you are going to get a big money out of some property that you have, then today your demand pattern will change. Yes or no? Correct. You will be more like, towards the spending side rather than saving side, because you know that a lot of money is coming. That is called as what? Consumer expectation. Then there are other factors which are the determinants. Okay, for example, there is size of population, correct? Size of population. There is, composition of population, or demography, we say in one word. Okay, what do you mean by that? See, if the size of the population is big, definitely the demand is going to be big. Okay, and composition, whether more of them are youth, or more of them are old people, or more of them are kids, or what kind of a composition of population it is, so that the demand will change uh, accordingly. For example, if you have a lot of kids and babies, correct? No, the baby food industry might flourish, the toys industry might flourish, correct? No, and if you have a youth, correct, no, which are like high school going kids or PU going kids, the demand for the computer games might be high, correct? But if the people are more of in the age of 35 to 45, then computer games might not work, correct? Now there will be demand for other goods, correct? So we have to understand these things. And there is credit facility, what is available, interest rate, what is prevailing, that is also determinant of demand. Also the level of national income, in the sense how the country is doing, whether the country is doing good or not, correct? That also depends. So these are the what we call in our discussion as what are the determinants of demand. So please, if you have any doubt, please type it in the chat box right now so that I can address. I'll give 20 seconds, then after that I'll go to the next topic. Yes, let us go forward. Okay, I'm going to not go in depth to the next small topics such as the demand function and all. If you read that once, you will understand. So I will go directly to law of demand. Now the law of demand states some things very clearly. Okay, what does that state? The law of demand in simple words, correct? No, what does that say? Law of demand. In simple words, it says that other factors remaining constant, if the price of the commodity increases, the demand falls, and if the price decreases, demand increases. Correct? That is what law of demand says. Correct? Now, on the basis of this, we had in the classroom, we have made a demand schedule. Correct? Now, we have seen when the price is 5 rupees, the demand is 10. When the price became 4, the demand increased to 15. When the price dropped to 3, the demand increased to 20. Correct? That kind of a table we made, and we showed demand schedule something like this, and we made a demand curve, correct, which was downward slope into the right. Correct, we have done that. So I'm not going to reiterate it again and again, which because it just wastes both of our times. So let us go forward and understand, correct, what are the rationale of law of demand, which means why does the demand curve slope downwards to the right. Okay, and the first reason why it slopes downward to the right, you should remember this, correct? No, the law of diminishing marginal utility. The law of diminishing marginal utility, which means when you consume one more unit of the same product, the satisfaction that you receive from the previous product, correct? No, satisfaction that you receive from this product will be less than the satisfaction that you received from the previous product. See, for example, you are very hungry and you had lunch. You felt very satisfied, but I give the same lunch to you again. Will you be satisfied the same way? Answer is no. Correct? Always when you order a pizza, when it comes home, the first slice or the first two slices will give you the extreme joy and satisfaction, but the fourth and fifth will not give you the same kind of satisfaction. This is nothing but law of diminishing marginal utility, which we will learn in theory of consumer behavior in detail. Okay, let us go forward. Okay, and learn more reasons why demand curve slopes downward to the right. Secondly, there is what price effect in the sense the same that if the price increases, demand decreases. Correct? And that's a law of demand in itself. Then there is something called as arrival of new customers. We have to understand this fact. Concentrate. Arrival of new consumers. Now what happens when there are new consumers in the market? Okay, when the price of the commodity falls, more consumers start buying it because some of those who could not afford it earlier now be able to buy it. Correct? Now, this raises the number of consumers of a commodity at a lower price, and hence the demand for the commodity in question. Okay, and this can be connected with another point called as different uses of a product. Different uses of a product. Now let me explain both of these points with one example that I'm going to give you is of olive oil. We know olive oil. Olive oil is usually used in what? It is used in cosmetics, correct? No, people apply it on their face and all that, and there are certain benefits to the skin and all that. But do you know that olive oil is one of the best oils for cooking? But people don't use it for cooking. Why? Because olive oil is costly. Per liter it costs somewhere around, virgin olive oil will cost you around 800 to 1000 rupees, correct, no, in the market. And no person will be comfortable buying that because other oils are available at a much more cheaper rates, such as 200 per liter, 150 per liter, correct. Nobody will pay 4 times of the money. But please understand, if the olive oil price reduces to, let us say, 300 to 400, if it reduces to 300 and 400, and what is going to happen? What is going to happen? The demand is going to go up. Not only the current demand, there are new people who will enter to contribute to that demand. Yes or no? Correct? Why? Very simple. See, the thing is, now the people who are using coconut oil also are considering what? Buying olive oil. that is called as arrival of new consumers, and this happens most often when the goods have different uses. Okay, when goods have different uses. Next, let us learn something with regard to exceptions to law of demand. Exceptions to the law of demand. Okay, first exception to the law of demand is conspicuous conspicuous goods. Now see, articles of prestige or value or snob appeal, we say, correct, no? And articles that of conspicuous consumption are demanded by whom? Who will demand it? The rich people demand it, and these articles become more attractive if their prices go up. Correct, no? That is something very exciting fact about it, that some people, when the price goes up for them, it becomes more attractive. See, for us normal people and all, what, if the price goes up, which is unreachable, we'll be like, we don't want those particular goods. But rich people are not like that. There are status seeking rich people who want these conspicuous goods, correct? And for them, law of demand will not apply. When the price go up, their demand goes up. Okay, it doesn't come down. Next, there are giffen goods. Please understand, you might already know the story of Robert Giffen and how he managed to see that when the price of the bread was increasing, the demand for the bread was also increasing. He was wondering why, because he did not study economics like we do. Okay, now we are studying very well, so we will know why. Because when the bread price increases, what happens? When the bread price increases, other products such as meat, etc., their price also increases. So people, instead of spending on meat and all, they are stocking up bread only, because they are thinking that in the future even bread will become unreachable for them. Okay, that is the reason, even when the price was going up, people were stocking bread, and the demand for the bread was increasing. That is called as Giffen effect also. Okay, now you have to remember there one point called as all giffen goods are what? Inferior goods. But all inferior goods are not giffen goods. Please remember that. All giffen goods are inferior goods, but all inferior goods are not giffen goods. Next, conspicuous necessities. Conspicuous necessities. The demand for certain goods are affected by the demonstration effect of the consumption pattern of the social group within which the individual belongs. These goods, due to their high constant usage, become necessities for life. For example, in spite of the fact that the price of television sets, refrigerator, coolers, cooking gas, etc., have continuously been rising, the demand does not show to fall, or there is no tendency to fall at all. See, this we have seen, and we have experienced also, correct? Is it not possible to lead a happy life without a TV? Definitely it is possible. But can you show me some houses where there is no TV? There is no. See, no, see, that is the thing. Whenever you call somebody for your housewarming, there are certain things that have to be there, correct? Because society tells us that those goods are necessary, such as fridge, TV, AC, correct? Now all those things, they have become something like a conspicuous necessities now. That is because of the society. Next, future expectation about prices. See, the thing is, it has been observed that when the prices are rising, the households expected that the prices of the future will be still higher. See, this happens usually when there is a famine or drought or any kind of natural calamity, correct? Now recently corona happened, and because of that, lot of agriculture has got affected. Okay, and when that happens, people expect that in the future agriculture products will become costlier, so people started stocking rice. Okay, so when you expect that in the future the price will rise even more, even though today it's costly, you will go and buy it more. That is when law of demand does not apply. Okay, and there are certain goods such as speculative goods, which are shares again, and there is a demand for necessities, which is defeating the law of demand. Then we went on to learn about what expansion and contraction of demand, and increase and decrease in demand. Correct? You should remember the difference. There are two things. What is that? Movement along the demand curve and shift of demand curve. You should remember these facts. I'm not going to touch upon it more. Okay. Please read about it. Okay. Next, let us directly go into the elephant in the room. Let us address the elephant in the room. What is it? The elasticity of demand. Elasticity of demand. Okay, elasticity of demand means what? What do you mean by elasticity? Elasticity of demand is defined as the responsiveness of the quantity demanded of a good to the changes in one of the variables on which demand depends. More precisely, elasticity of demand is the percentage change in the quantity demanded divided by the percentage change in one of the variables. What is it? Percentage change in quantity demanded divided by percentage change in one of the variable. Now this variable can be four things in our study. What are the four things? It could be price, it could be income, it could be cross, it could be advertisement expenditure. Correct? Yes, remember this. Okay, remember the formula. See, I'm not going into the derivation of formula and all. Correct? How many types of how many types of elasticity is there? Do you remember? Do you remember something called as point elasticity? Point elasticity. Huh. Arc elasticity. You remember arc elasticity? Thank God that some of the replies are positive and they're saying that yes, we remember. Okay, good, because you have to remember, because the crux of the chapter is this. The crux of the chapter is this. Correct? There are the easy formula for calculating price elasticity. For example, first we'll talk about only price elasticity. The formula is what? Percentage change in quantity demanded divided by percentage change in price. Yes or no? Correct? And we brought it down and we did it what? Change in quantity divided by change in price into price divided by quantity. That is what our we boiled down to at the end. Yes or no? Change in quantity divided by, let me just write it down for you. Change in quantity divided by change in price multiplied by price divided by quantity. This was the formula we learned first. Yes or no? Correct? Then I'm going to discuss about the other things also. Okay, then there are a lot of sums in the book also, textbook, and lot of my MCQs I have also given. So please study that as well. Okay, now next one, there is arc elasticity. Arc elasticity, what is the formula, students? Do you remember the formula for arc elasticity? Yes, you should remember. The formula is what? Q1 minus Q2 divided by Q1 plus Q2 multiplied by P1 plus P2 divided by P1 minus P2. And we had so much discussion about the which type of elasticity is better and all that. Correct? And we found that arc elasticity is superior. Yes or no? Arc elasticity is superior to point elasticity. And we learned about different kinds of elasticity. Yes or no? Correct? And there is how many types of elasticity? There is unit elastic. There is, what are the other kinds of elasticities? Correct? Please try to put it in the chat box. I'm waiting for your answers as well. Okay, it is not that it is one-way communication. We have to be uh, interacting with each other. Correct? No, when there is elasticity is 0. Correct? Quantity demanded does not respond to a price change. When elasticity is 1, the percentage change in quantity demanded is equal to percentage change in price. When elasticity is greater than 1, what happens? We call it as what? It is to be elastic. When elasticity is less than 1 but more than 0, what is it? It is called as inelastic. Correct? Now, uh, so tell me, what are the different types of elasticity? There is perfectly inelastic. That is when elasticity is 0. I will write it down. When E is equal to 0, it is what? Perfectly inelastic situation. Correct? Then it is more than 0 but less than 1. In this situation, what happens? It is called as inelastic. Correct? And then it is 1. If it is equal to 1, then it is unit elastic. And then it is greater than 1 but less than infinity, right? Then it is elastic. Then if it is infinity, then it is what? Perfectly elastic situation. Perfectly elastic situation. I hope that these things are clear. Then there was one more method called as total outlay method for calculating elasticity. Total outlay method was there. I believe that you can revise on your own, because there is nothing more to explain there. Correct? No, it is pretty. There are no numbers over there. It is just a understanding. Okay. Now let us go to the determinants of price elasticity of demand. Okay, what determines the price elasticity of demand? First of all, we have to concentrate on the availability of substitutes. Okay, let me just write it down. Determinants of price elasticity of demand. Determinants of price elasticity of demand. Yes, first one is availability of substitutes. Now there are some doubts which are coming my way. Let me just address them once. Okay. uh, yeah. Okay. uh, Krishna, I will provide you this thing, what the daily routine to study. Okay, once our last revision class, during our last revision class, I will provide to you. Okay, so that you can be very clear about how to go about your studies and all that. Don't worry. Okay, your studies is kind of our responsibility as well. Okay, as your teacher, I want to make sure that you clear your examination, and I will give you a kind of routine to study in the remaining days. Okay, do not worry about it. So let us get back into our discussion, and no more doubts have been posted, so I'll go forward now. Next, availability of substitutes. See, one of the most important determinants of elasticity of degree of availability elasticity is the degree of availability of close substitutes. Some commodities, like for example, you can take Coca-Cola. Okay, well, they have very close substitutes. Yes or no? Correct. Coca-Cola have a very close substitute. What is it? Pepsi. Now they are, for example, what happens in this case? A change in the price of these commodities, the price of the substitutes will remain constant, can be expected to be causing quite substantial substitution. For example, if I am selling Coca-Cola at 10 rupees and Pepsi at 10 rupees, and if Coca-Cola price increases to 12, correct, the demand for Pepsi will go up. Yes or no? Correct. Why? Because it's a very close substitute. Now this is this depends how much elasticity is there, is highly dependent upon the availability of substitutes. For example, for electricity, what is the substitute for electricity? There is no substitute for electricity. Yes or no? So if the price increases also, you have no other option but to consume it. Correct. Now there is no substitute, but in other cases there are substitutes, and when there are substitutes, there will be a lot of elasticity. Next, there is second one, position of commodity in consumers budget. I had given a great example in the class. Do you remember that? Right? A position of a commodity in a consumer budget. For example, matchbox. Okay. See, every households need matchbox, correct? No, to light and to cook, etc., etc. correct? You need matchbox. Now when that for example a matchbox cost you 5 rupees, and let us say in a month that 5 rupee matchbox the price raised to 10. Okay, there is what 100% increase. So will you stop buying matchbox? No, because why? You are buying items worth 5,000 6,000 rupees every month for grocery, and what is 5-10 rupees doesn't make a big difference. So you have to see what is the position. Okay, what is the position that the commodity holds in a consumer's budget. Next, depends upon the nature that the commodity satisfies. For example, see, luxury goods are price elastic, where necessities are price inelastic. In the sense, if whether you have money or not, you have to eat. Essential goods you'll definitely buy, but you want something like a super bike or something like that, car and all you want. But when the price is high, you will not buy it. You'll postpone your decision. Yes or no? Correct. Next, it also depends upon the time period. It depends upon the consumer habit. It depends upon the tight demand. What is tight demand? Let me tell you. See, uh, if at all, if you have seen any diabetic patients, okay, diabetic patients, they take insulin, correct? Now, once they start taking insulin, correct, they will first buy a insulin pen, which they inject, correct? And once that pen is bought, you have to buy the needle of the same company. Now, this is something called as a tight demand. Please understand, correct? Because the other company needles will not fix into that pen. Okay. Now this is called as what? Tight demand. It goes same for that glucometer we say. They just prick a small hole in your finger, and they take the blood and they check your sugar levels in 5 seconds. Correct? No, there are different companies which make this glucometer. But once you buy a glucometer, you have to buy that strip from that company only. This is called as tight demand. You cannot do anything about it. Correct? So next you have to see about the price range also. What is the price which is kept in the market, etc., etc. So please give it a read also. Okay, so we'll go forward. We have lack of time. We have to cover a lot. Next, that is about price elasticity. Next, there is income elasticity. Nothing, just the denominator changes. We know that percentage change in quantity demanded divided by percentage change in income this time. Correct? And the same way we have cross elasticity. What is cross elasticity? Cross elasticity is where I'm not comparing the price and the quantity of the same product. I'm comparing the price of one product, quantity demanded of another product. Now, what is this another product? Two types. Again, there are complementary product and there is competitive product. Correct? Now tell me, complementary goods. Complementary goods. What do you mean by complementary goods? Do you remember? What do you mean by complementary goods? Huh? Yes, we just discussed about it. Correct? No? That's pen and ink. Yes, or pen and refill. We say they're complementary goods. If you buy one, you have to buy one more. So here, do they have direct relationship or inverse relationship? Pen, for example, costs 10 rupees. Refill, for example, costs 5 rupees. Correct? If the price of pen increases, what happens to the quantity demanded of refill? Quantity demanded of refill will decrease. There is what relationship here? Inverse. See, it is pretty clear. Okay. Why? Because take an example of petrol and bike. If the petrol prices increases, will people buy more bikes? No, they will look for alternatives. And today I'm happy to say that there are a lot of substitutes for a automobile vehicle. Now there is electric vehicle. Yes or no? The electric bikes are there today. Correct? So going forward, next there is what complementary, and there is next is competitive goods. What kind of relationship does competitive goods or substitutes have? Substitutes like Coca-Cola, and there is Pepsi. Coca-Cola price is at 10, Pepsi price is also at 10. Coca-Cola price increases. What happens to the quantity demanded of Pepsi? If Coca-Cola increases the price, people will stop using Coca-Cola and they start buying what? Pepsi. So the quantity demanded increase. So here what the direct relationship is there. You have to remember this. Next. Advertisement elasticity, I'm not going to cover much there. It is nothing but the denominator change in our formula, percentage change in quantity demanded divided by percentage change in the spending on advertising. Okay. Next, there is a small concept called as demand forecasting. In the previous revision class, I had told you about demand forecasting that we'll discuss here. Correct. Now there are a lot of types of goods which are explained, and we have to know how to forecast for each of them. We have to learn the difference between producer goods and consumer goods. Producer goods are the ones which are used by home producers. Consumer goods are used by consumers. Correct. Next, durable goods and non-durable goods. What do you mean by durable goods? Which can be used over a time. For example, TV, AC, fridge. Non-durable goods. Non-durable goods are more of experience basis. Yes or no? Correct. Which cannot be used for long period of time. Correct. Next, there is a derived demand and autonomous demand. Okay. For example, the demand for a commodity that arises because the demand for other commodity is called as parent product is called derived demand. For example, the demand of cement is derived from the demand of what? Building activity. Yes or no? Derived demand. Please understand some important aspects I will cover. Derived demand means what? The demand for a commodity is derived from some other demand. For example, I want a building, so I want cement. Just like that, will you go to store and ask for cement? No. Only when there is some other demand, to satisfy that demand you need this. This is called as a derived demand. Autonomous demand is what? Independent demand. Okay. It arises on its own. Okay. For example, you want to eat in the afternoon. Why? Don't eat, no? Correct. No, you are hungry, you have to eat. The demand for food comes as what? Autonomous demand. Next, there are short run, long run demand, etc., etc. Please go through those points. Okay, there is nothing more to explain over there. Everything is readable and understandable. Then there is something called as method of demand forecasting. Okay, there is surveying the buyer's intentions. There is collective opinion method. There is expert opinion method. There is statistical methods. You have learned in statistics, graphical method, fitting trend equation, etc., etc., etc. Correct, which is not much important. Okay, but give it a read once. The majorly in this particular unit, our concentration will be towards only elasticity of demand calculation. Okay, we have to make sure that before going to the exam you have to learn a lot about elasticity, because most of the questions are asked from that particular area. Elasticity, then demand curve. Correct. And all the graphs which are involved therein, that is very important, which you have to cover. Now with this we have finished the first unit. Now we have to go to the second unit. Just take a minute. Okay, and we'll get back to it. Yes, let us come back and let us continue from where we left off. We have to discuss now Unit 2, that is Theory of Consumer Behavior. Okay, and in this we are starting our discussion by discussing about what do you mean by human wants, correct? No, and what are the characteristics of wants? Wants are unlimited, wants are differ in intensity, each want is satiable, wants are competitive, wants are complementary, wants are alternative, etc., etc., etc. There are so many characteristics. I believe that they are self-explanatory. I'm not going into the core of that. We have to discuss two important aspects in this chapter. Although I'm not going to talk about necessity and necessaries, comforts, luxuries, etc. You already know about it. You are at that point of your life in CA Foundation that you have to know the differences between all that. So let me just directly address the two different kinds of analysis that we are going to do here in this unit 2. One is marginal utility analysis. Second one is called as what? The indifference curve analysis. First of all, let me start marginal utility analysis. What is marginal utility analysis? Marginal means additional, correct? No, if at all you consume the same amount, okay, or same item again, the satisfaction received from the previous item will be more than the next item. That is what is the total the calculation wise whatever has been explained. Now marginal utility theory is given by Alfred Marshall, who is a British economist. We already know about Alfred Marshall. We might have studied in 12th as well, correct? Now next, see, there are certain assumptions of marginal utility analysis. First of all, what is it? A consumer is supposed to be rational. Okay, rationality is the first assumption. Okay, which is in practical life this is seen very less. Okay, consumers do not make rational decisions, and we have to understand that it is a cardinal measurability, okay, of utility. According to neoclassical economists such as Alfred Marshall himself, utility is a cardinal concept. That is, utility is measurable. Okay, we call it as utils. So if I eat an apple, I can say how much is my satisfaction by telling about utils. I can say that I received 50 utils. It is called as cardinal measurability. Okay, now next is the constancy of marginal utility of money. Okay, they say that marginal utility of money is constant. Yes or no? Correct. If you have 1,000 rupees, if I give you one other 1,000, will you say no? Answer is no. You will take it. Yes or no? Correct. Next, the fourth assumption is that it's a hypothesis of independent utility. Independent utility. Okay, which means the total utility which a person gets from the whole collection of goods purchased by him is simply the sum total of all the separate utilities of goods. Okay, now which means that it ignores the interrelationship or the synergy, we say, correct? It does not include that. Okay, next. Next, the law of diminishing marginal utility I've already explained to you. Okay, I'm not going to go in depth of it. Correct. Everybody knows what is the law of diminishing marginal utility. We have heard that example of pizzas, example of apples enough number of times to know, correct, what it is. Next, let me directly go to the limitations. Okay, what are the limitations of law of diminishing marginal utility? First of all, it is only considering homogeneous units. In a sense, for example, the units that we consume constantly, okay, one after the other, should be homogeneous or they should be same. Okay, example, uh, first I will give you a normal pizza. Okay, first slice is a normal pizza. Second slice, I will give you the cheese burst pizza. Now tell me, second slice gave more satisfaction or the first one? Second one. Yes or no? Why? Because the units are not homogeneous. Okay. Now, that is the limitation. The units have to be homogeneous. Next, standard unit of consumption. Imagine you're walking in a desert and you need water. I have water. You come to me and like, give me water. First, I will put 1 spoon of water in your mouth. Okay. Next, I will put one more spoon. Now tell me, which spoon gave you the much satisfaction, the first one or the second one? Okay, definitely the second one. Yes or no? Correct. So the utility should be calculated only with the standard unit of consumption. For example, in case of water, it should be a glass or a jug. Okay. Next, there should be continuous consumption. For example, pizza. I give you one pizza today, second pizza I'll give you tomorrow. Will it give you the same satisfaction only when you continuously consume it, which is not possible in the practical world. That's or no, correct? So only when you continuously consume, it is calculated right. And there are certain other limitations which are not so important. Then there is a small concept of consumer surplus. What do you mean by consumer surplus? What a consumer is ready to pay minus what he actually pays. So what is consumer surplus? What the consumer is ready to pay minus what he actually pays. Correct. This is easy. Next, uh, consumer surplus again is not a very practical concept. There are its own limitations which you have to go through. Next, there is indifference curve analysis, which is very important. What is indifference curve? Indifference curve is a curve which represents all those combination of two goods which give the same satisfaction to the consumers. So instead of calculating the utility, instead of calculating utils, here I give you options. See, you can have one chocolate and 12 ice creams, or you can have two chocolates and six ice creams, or you can have three chocolates and four ice creams, etc., etc. I'll give you combination of two goods, correct? And all these combinations should give you the same level of satisfaction. That level, whether it is told in number, answer is no, it is not told in number. Then we will draw something called as indifference map. Okay, and there are certain properties of indifference curve. What is that? Indifference curve slope downward to the right. Indifference curve are always convex to the origin. Indifference curves can never intersect each other, correct? Now all these reasons have been explained in much detail, okay, in the classroom discussion. So I want to just tinker your memory so that you can go through it again. Okay, please remember. Next, we had a small concept called as budget line, correct? Budget line is drawn. How budget line is drawn? Tell me, correct? How budget line is drawn? Budget line is drawn by this. What? I will calculate my total budget. For example, it could be 5,000 rupees divided by the price of commodity A and how much I can purchase. Same thing I will do, 5,000 rupees divided by price of commodity B, and I will get these two numbers and I will join these two numbers in the graph. That's how I draw budget line. You should be remembering it. And we will select that indifference curve to which budget line runs as a tangent, correct? We have seen that. Now this is with regard to indifference curve analysis and marginal utility analysis, which is the crux of the chapter. Okay. Now slowly we will have to move on, and we have to learn. One second. There is a single doubt coming in. Let me just address that. Certain doubts which are coming in. Okay, I did not understand that question. Maybe you have to frame it in a different way. Please let me know. Okay. Next. There are no questions. Okay. Okay. In that case, I will go forward. Okay. And see, the thing with the revision classes, the concept of revision classes. Okay, you have to understand that we need to keep our ground and make sure that we do our efforts even after the revision class. Okay, revision classes are there just to make you remember that there are certain concepts which are important, and this is how they are explained. Revision classes will be much more helpful for you when you have done your first round of revision. Okay, so that is very important. You have to make sure that you do your first round of revision, so that whatever we do here is you know fruitful. Okay, if you don't do your homework even after the revision class, then in the examination you will come into a very difficult scenario. Okay, I'll tell you what that scenario is. See, if you're writing an examination and let us say that you don't know the answer to a question at all. Okay, you might not regret it much, because I did not know it at all, I did not study. Okay, but imagine a situation that you're sitting in the examination hall and you know the answer but you can't remember because you studied it but you didn't revise it. Now that is the position which puts you into most of the regret. Okay, that is that kind of regret is unbearable in the examination. So we are helping you not to have that kind of regret. Okay, so yeah. Okay, going forward, going forward yes, we have to go to unit 3. Okay, unit 3 is nothing but supply. Okay, unit 3 is supply. Now supply, we will learn it just like how we learned demand, the same things. What do you mean by supply? Supply refers to what a firm offer for sale in the market, not necessarily what they succeed in selling. So does supply means sale? Answer is no. Supply doesn't mean sale. Supply means what is supplied or offered for sale in the market. Supply is a flow. The quantity supplied is so much per unit of time, per day, per week, or per year. Okay, please understand, supply is not equal to sale. This is one of the favorite question of the examiner. You have to remember this. Next, there is a determinants of supply. Okay, determinants of supply such as price of the good, price of the good. There is price of related good, price of the related good. There is price of factors of production. I will explain that all of them to you. Wait for a while. Okay, and there is state of technology, and there is government policy and competition. These many determinants are there of supply. First one is price of the good. See, if the price is more, the supply will be more. Why? Because the supplier wants to make more money. If the price of the goods go up, they will try to supply as many as possible. So it's exactly opposite to demand. Next, price of related goods. See, if the price of other goods rise, correct? For example, I am producing Coca-Cola and price of Pepsi is increasing, which means I will stop selling Coca-Cola. I will start selling what? Pepsi. Why? Because Pepsi is giving me more profit, correct? So you have to think here from whose point of view? Supplier's point of view. Next, there is price of factors of production, which means factors of production means what? Land, labor, capital, organization. We already know that, correct? If your labor prices are increasing, correct, then what happens? Cost of production will increase. See, a rise in the price of a particular factor of production will cause an increase in the cost of making those goods, that use a great deal of factor, that in the cost of producing those goods are relatively small amount of factor. For example, a rise in the cost of land will have a large effect on the cost of producing wheat and very small effect on the cost of producing automobiles. Thus, change in the price of one factor of production will cause change in the relative profitability of different lines of production, and the producers will shift from one to another. Okay, so whenever we produce, correct, now we have to make sure that the factors of production and their costs are properly calculated and they are not volatile. The moment the factors of production cost will change, your total cost of production will change, and your supply also will change. Okay. For example, imagine that in the example, I will give you an example. Listen, see, imagine in the middle of the city, correct? In the middle of the city, you have land. You have, like, 20 cents of land, and in that land, currently you're running a hotel. Currently, you're running a hotel, a normal restaurant. Now, tell me, when the price of the land, or when the, maybe you got that land, ancestral land, from, like, past 100 years, it is passed on to you. Okay. In that case, at that time, hotel might have been a good business in that land. But tell me, today, in the middle of the city, such a big land, will are there not any other options which you can have to make more money through that land? You can build a commercial complex, you can build a mall, you can build so many other things, correct? Now, why you have to run a small hotel? Yes or no? Correct. So the supply will differ on the basis of factors of production as well. Next, there is state of technology. There are new technologies which are coming up, which reduces your cost of production and change in supply accordingly. Then there is a government policy, which means that sometimes government wants certain types of goods to be supplied in abundance. At that time, they will support you by giving subsidy. Yes. For example, currently government is subsidizing any research with regard to COVID vaccine. Yes or no? Correct. So the thing is, the supply gets affected because of that. Okay. Next, competition definitely is one of the major factor of supply. Next, there is law of supply. See, the thing is, law of supply can be stated as follows: ceteris paribus, that is, other factors remaining constant, the quantity of a good produced and offered for sale will increase as the price of the goods rises, and decreases with when price falls. So there is a direct relationship, direct opposite of law of demand. You should remember that. Next, there is, again, just like demand, there is movement along the supply curve and shift of demand, I mean supply curve, which both you have to, like, go through. It's the same thing. Okay. There is no difference with regard to that. Then there is elasticity of supply. See, this is where the major differences come into place. Okay. Percentage change in the quantity supplied is the numerator, divided by percentage change in the price. But only one thing you have to remember here is that the uh, elasticities of supply, what we are learning, we are not learning four types like we learned in the demand. In demand, we learned four different types of elasticity. Okay. The variables were four. What are those? There was price, there was income, there was cross elasticity, there was advertisement elasticity. But here we have what? We have only price elasticity of supply. Okay, nothing else, price elasticity, and that only have been explained further and further. Okay. Now let me just take a small example. How is elasticity of supply is calculated? Percentage change in quantity supplied divided by percentage change in price. Yes or no? Correct. So, or I can put the formula like this: delta Q divided by delta P multiplied by P divided by Q. Am I right? Yes. Now, there are types of supply elasticity. Just like demand, there are how many types? 5 types. What is that? Perfectly inelastic supply, relatively elastic supply, correct? Or relatively inelastic, unit elastic, yes or no? And perfectly elastic. Perfectly elastic, perfectly inelastic, correct? Relatively elastic, relatively inelastic, correct? Then there is unit elasticity, correct? We have to remember this. Now in that also same thing is there. What is it? The arc elasticity and point elasticity concept will come, correct? We know the difference between arc elasticity and point elasticity. What we learned here, correct? Now this particular formula is point elasticity, yes or no? Correct. Where to make it arc elasticity, what I have to do? I have to refine the formula, and it will become the same formula. What is it? Q1 minus Q2 divided by Q1 plus Q2. If you have attended my class, and concentrated. Now when I'm saying this, you will 100% get it. Okay, you will get it 100% because we have gone through this in so much depth, correct? Multiplied by P1 plus P2 divided by P1 minus P2, correct? This is the formula for arc elasticity, and through this we will do the calculations. Now I will take further a little more time, okay, to explain to you the strategy to learn this particular chapter. Okay, the strategy to learn this particular chapter is to first learn about elasticity. Okay, you have to make sure that first you learn about elasticity, and then we can then we can go about and learn the other things. Okay. Uh, oh, okay. My chat box is not receiving any messages. Okay, I don't know. I believe that even if you have any doubts, we can connect through different ways. You can connect to me directly. Also, you can send your yeah, you can also send your questions through the app so that I can answer it there. Okay, so let me just tell you what is the strategy to learn this particular chapter 2, correct? There are 3 different units. As I told you, there is demand, there is theory of consumer behavior, and there is supply, correct? Now demand, correct? No, you have to concentrate on elasticity, okay, because that is where most of the questions are asked from. And here graphs also you have to make sure that you calculate, correct? And theory of consumer behavior, the more importance have to be placed on indifference curve, more concentration have to be given for where? To the indifference curve. And supply, you have to concentrate on, again, on elasticity of supply. So if you ask me what are the key topics, okay, in chapter 2, these are the key topics. These have to be 100% studied. Like, if you can study it 10 times, do it, okay, because most of the questions are asked from this area. Okay, then after that, what do you do? After that, you study the other topics. This doesn't mean that you don't study the other topics. I'm telling you only because you have to prioritize certain things just before the examination. Okay, now you have to concentrate and study everything. Okay, next, so in the next live session we will discuss about the 3rd chapter, which is again an important chapter. So until then, let us keep studying, and further live classes will be notified to you. Okay, and enough for today. Take care, and if you have any questions, I will further wait for another minute in the chat box so that I can address them. Then after that, I will end the live. Yes, Wish Joysa. Okay, your question I will address. Can you please explain again about how law of marginal utility affects the demand curve? See, the demand curve, okay, the demand curve, we have seen that it slopes downward to the right. And I said the one of the reasons why it slopes uh, uh, downward to the right is because theory of diminishing marginal utility. That was the explanation which was given. Now, Vish Joysa has asked me a question. How? Okay, let me tell you how. See, what do you mean when I say demand curve slopes downward to the right? It means that when the price, see, x-axis and y-axis, where x-axis is quantity demanded and y-axis is price. It says that when the price is coming down, correct, the quantity demanded is increasing, correct. That is what demand curve says. And the reason, one of the reason is what? Diminishing marginal utility. The thing is, imagine about this. You are very hungry and I will give you a burger. Okay, you are very hungry and I'll give you a burger. Okay, now I tell you the price of this burger is 100 rupees. Okay, the price of this burger is how much? 100 rupees. You are so hungry that you will pay 100 rupees, you will eat that burger. Okay, and now you are a little more hungry. So again, I will show you a burger and tell you that give me 100 rupees. Now you are hungry, you agree, but are you as hungry as you were before eating the first burger? Answer is no. Which means, will you be willing to pay 100 rupees now? No. Yes or no? You want to pay something less than 100 rupees. Something less than 100 rupees. That is why, there is a downward sloping, which means the price, correct? No, for the price what you are paying, you expect something more than a burger now. If at all I tell you that you have to pay 100 rupees anyway, you will expect something more than a burger, correct. That is one of the reason why there is a drop and it drops downwards to the right. Okay, technically looking at it, but this is explained much better in later, where in unit 2, correct, where we are going fully into the theory of marginal utility analysis. We learn it in a much more greater extent, but this is one of the reasons, it's not the only reason for the demand curve to slope downward to the right. I hope that answers your question. And uh, okay, no more questions. Okay, so enough for today. We will yes, wish Joysa. I'm happy that you understood. Yes, let us end the class for today, and we'll meet in the next revision class, which will be notified to you. Until then, keep the good work going, keep studying, and stay positive.